Hello and welcome. You're listening to the West Clay Realty Podcast, hosted by Scott Pollard and Joe Kempler.
Hello and welcome to the West Clay Realty Podcast. I'm your host, Scott Pollard, and today I have a guest named Michael Johnson from Loan Depot, and we're going to discuss mortgages. When I'm going through process with clients and some of them are looking for a loan or a mortgage to help buy their new home, I know a little bit about mortgages, and I know more than most about mortgages. However, we do work with people that know everything, because I would prefer to refer you to somebody that knows everything, that's been in the business for a long time, and that way they can answer any hard questions you may have that I certainly can't, and nor am I qualified to. So as an ethical responsibility, it's part of our agent thing that we don't give legal advice. We don't give mortgage advice beyond basics. So Michael Johnson, welcome to the show. Thank you for being on with us. First question, softball. What just a quick overview of what it's like applying for a mortgage for some of the younger people out there that may have never purchased a home before. What is that process like, and what can they do to help themselves be qualified?
Yeah, so the process in 2020 is totally different than it was when your mom and dad were probably giving you advice on mortgages. Right now, everything is digital. So you can literally, from your cell phone in 8 minutes, do your entire application. And so I send you one link, and you can take that link on your phone and comply in everything, every question that they're going to want to know. What's your name? What's your social security number? What's your date of birth? What address do you live at? Where do you work? Can all be answered on your phone in the car while you're driving to go see the house that you're trying to go buy. And wow. So you can be pre-approved in the car as you go to the house that you want to get.
I'm going to look at a house on Finchley Road in Carmel, Indiana. I've got a pretty good job. We're looking in this price range. Hey, Michael Johnson, can you send me that link and so I can get pre-approved on the way to the showing?
You absolutely can. Yeah.
Wow.
And so when I get it, when I send it to you, and it's a pretty easy link, I need to get preapproved.com. So, because you probably need to get pre-approved. And so that's why you're calling me. So we did that. So I need to get preapproved.com is an easy link. They go to that, they fill out the application. That immediately comes back to me. I look at it right away, and then I can either issue you the approval, or we can discuss. Let's say you're not ready, you want to save more down payment, whatever it is you want to do, we can discuss what that looks like. So, but you can literally be pre-approved on the way to your next appointment.
Wow. All right, Michael. Speaking of your credit report, credit score, whatever it is, and there's a lot of commercials out there that I believe are misleading about your credit score. I believe that they are trying to sell you something, which of course all commercials are, right? Tell me some things that you've run into in your 15 years of being who you are and what you do, that people do, maybe there are mistakes they make on their credit when they're applying for a mortgage to make the biggest financial decision that most of us ever really make, which is buying a house.
Yeah. So most people, when they look at what they know, if they know their credit history in the past, you know that while I was in college, I forgot to pay like every single credit card that I opened up. So I still owe Abercrombie and Finch, $300 for a pair of jeans, and you're trying to buy a house. Well, that's probably going to show up still. And so those type of things, people sometimes look at some of the national advertised sites, and they'll get a credit score and they think that's what it is. Most people don't understand that a lender's credit score is significantly different in how they weight the information. So a lot of them like car payments, a lot of them like credit card payments, a lot of them like house payments. The more of one of those mixes that you have, the more your credit score is going to be affected. And so when we typically see credit scores, they're 30 to 40 points lower than what you see on the national come run your credit report numbers and all that kind of stuff, which can hugely affect your buying power when it comes to doing that. So first step is really to call the lender, get your actual lender credit score. Then when you do that, the mistakes that we see, which if you've never bought a house, you wouldn't really know some of this stuff. So a lot of times when you go buy a house, like get your first house, you're coming out of an apartment, you certainly don't want your apartment furniture into your new house. So what's one of the first things that you do? You run over to Ashley Furniture or our house, and then all of a sudden, same as cash for 120 days, 180 days, 2 years, whatever it is, and you buy that stuff. And then the credit report then puts an inquiry on your credit, and the lender is then notified. And so then I call you up and go, hey, Scott, I got a report that says you've purchased $92,000 worth of furniture.
Which is a big number, but if you're buying a big house, that's not that big of a number.
Yes. Or it's a really nice couch.
Yeah.
And so I have literally had people buy a truck. They were struggling to qualify just in general. We got them approved. We're ready to go. We are a week before closing. They go buy a truck. It's a $900 truck payment. You want to guess where they're living?
Not in that new house. Yeah.
Right. No, I hope it has a really big cab, because that's the kind of stuff people do. They don't understand that when you buy something new, that new debt has to be counted for your new house that you don't even have yet. And so, and it can be it can be just nothing. I'll give you an example. My father, when we were doing a refinance, he went, and we were at, I don't know where he was at, Cabela's. He bought bug spray. Okay, bug spray. And he saved 10 cents if he opened up a Cabela's gift card. Okay, fantastic. Saved your 10 cents. However, it triggered the report. And when it triggers the report that you opened up a new account, we had to wait a week to close his own refi, my own dad, that we have to show the new Cabela's gift, the new Cabela's report, the new payment, the new everything on this, and it delayed it an entire week over saving 10 cents. And he didn't know. And that's a fail for me because his own son didn't even tell him. But
so is it fair to say that a lot of people don't understand that when you, after you apply and you're waiting for that loan or mortgage to come through, it's safe to say that a lot of people don't understand that even a minor purchase like that can affect your credit score. And the reason why is because, and again, I didn't know this before not too long ago, because back in the old days, I bought cheaper houses that I didn't really get mortgages for. So when I started learning more and paying more attention to the actual process, I learned that there were things that I was doing that was not helping my credit score, like paying off an account that I could easily pay off, but leave it open because they do like a history, or just at least make regular small payments on a credit, because that's a good thing for whatever reason. And I still don't understand why, but that is a good thing to keep just credit open that you're making payments on, or that you've paid off that credit card but don't close it, or an account that you've paid off and your balance is zero but don't close it. Can you explain that?
Correct. Yeah. So many years ago, I was licensed with the state to do credit repair and taught classes to a lot of the incoming real estate agents. And part of what my role was in that was 100% just talking about credit repair. And so what you're referencing is, if you have, the best example I can give you, if you have 10 accounts and they each have $1,000 credit limit. So you have a $10,000 option to max out all your cards. And let's say that you have 5 of those accounts maxed out. So you're occupying 50% of your credit. And you decide, hey, I don't have these other 5 accounts. Let me go ahead and close those. And that way it'll look like I don't have all these accounts, so I can't rack up another $5,000. So the lender will then be safer that I don't knock off $5,000 more. So you do that and you close those accounts. Some of those accounts could have had 2-3 year credit payment histories, and you close all of those. Now the lender sees, instead of a $10,000 credit line that you have $5,000 used up on, you've taken your $10,000 credit line and now you only have $5,000, and you've maxed out the entire $5,000, because we went from 10 accounts with only 5 of them being utilized to now 5 accounts and 100% utilization. So that makes it look like you can't manage your credit accounts and that you're maxing out cards. And when lenders see you maxing out cards and credit reports see you maxing out cards, they get a little nervous, because you don't have any, why are you maxing out cards? Like you don't have enough savings. Like we start, you don't want us looking. And so that's what keeps us looking is the more layers of risk, the more credit cards you have maxed out, that just creates a drop in your score. So
you want cushion.
Yeah, go ahead.
You want cushion. You want to have an account if you can possibly afford it.
That we can see, you can manage. You can have $10,000 and only use $2,000. Fantastic. That you have the ability to manage and not overspend. What other people do as well, because credit goes it's not the easiest thing to do and manage because it doesn't make sense. If I have a collection account, so that we talked about before, I had a $300 Abercrombie jeans collection and I didn't pay it and it's 5 years old. And now I'm ready to buy a house and I'm going to go back in and I'm going to make that right. And I send Abercrombie a check for $300 and I paid that account off and my credit score went down. And people are like, why did my credit score went down? I paid off a debt. What happened is that debt was over 2 years old. You reopened that debt by paying it off because then they came back and reported that debt as now being active and paid off. So even doing the right thing in credit can produce the wrong results. So you should definitely talk to a lender, me specifically, to give you exact advice on which accounts to pay off, which accounts to leave alone. Medical stuff is looked at 100% different than if you defaulted on your Honda. So it's a big difference when it comes to which types of accounts.
And go into, it kind of goes into your dad's story with Cabela's, but another thing I didn't realize many years ago was that just opening up a new credit card will usually negatively affect your credit because they do a full pull. I guess that's the term. They pull your credit. And so the more times your credit is checked by a lender, by Visa, by Cabela's or whatever, that can negatively affect your credit score. And so to your exact point, you're going to buy a house and you're thinking, oh, I'm going to go over to, I don't know, someplace here, Abercrombie and Fitch, not Abercrombie and Fitch, Saks or whoever sells furniture. I'm not going to give out any brands, but somebody that sells furniture, I'll just apply for a store credit because I don't want to affect this mortgage. But yet that application for a credit with that store is going to do what?
It'll drop a couple points for every time your credit is pulled. What we've noticed in our industry, some of the changes to our industry now, and it wasn't always like this, but if you shopped mortgages, every time you shopped your mortgage, your credit score went down. So the first lender may have had a certain score. The fifth lender is going to have a 10 to 15 point lower score. And it may be drastically different in the rates that you can do. So in our industry, they've changed that. They've given us a 30-day window. And if I pull your credit and if another lender pulls their credit in that 30 days, we get the same score. It doesn't negatively affect you. However, when I can 100% tell you what I see is in the auto industry, they don't do it like that. They will literally shop you 10 places and 10 different credit reports and 10 different credit scores. And you can go from you barely qualify in one area to you don't qualify at all because this credit score has been brought down. And so it's a big difference if you're on a borderline credit score, and it can be really high borderline credit score. Like you can have an A, but not an A plus. And an A plus credit score may provide you an eighth of a point better. On $1 million house, an eighth of a point better could be $100,000 over the life of your loan over 1 point. So it's a big deal when it comes to credit reports and having them not pulled. And every inquiry that you have on your credit report, you have to provide exactly who pulled it, why did they pull it, and what are the results of that pull. And so the lenders know that. They monitor your report from the time you open it up to the time that loan closes.
So don't go shopping right after you apply for a mortgage. Don't go look for a car. You can compare a couple mortgage companies within 30 days, but don't go opening up new lines of credit because it will negatively affect your score and you might get denied on your mortgage, which is the most important thing. So listen to your mortgage broker, listen to your Michael Johnson. Switching gears a little bit, Michael, we've already applied. We've already been accepted. We are moved into our new house. And a couple of months later, instead of getting our mortgage bill from companies A, B, C,
Yeah.
all of a sudden the bill starts showing up from XYZ company. Can you explain that?
Yeah. So a lot of lenders will sell what's called their servicing of the mortgage. So the best example I could give you would be, I started your mortgage. You went to the bank of Michael. Michael gave you the money. And then all of a sudden you start getting a letter from Scott that says, hey, please pay us instead. In between that, you received a letter that said from me, I'm selling your loan, or I'm placing the servicing of your loan with Scott, and make your payments instead of to me, make your payments at this address now. And you don't get any choice. There's not a, no, I don't want to do that. There's no, I'm opting out. No, you go where you're going. And so lenders do that for a couple of reasons. One, it's exceptionally profitable to sell loans. That's the number one reason why every lender does that. So a lender will pay another lender a certain percent of the loan up front in order to have the opportunity to take your loan, the new client loan, for 30 years or 15 years, whatever that term was. They do that because now they can market to you, hey, maybe you need a checking account, maybe you need a savings account, maybe you need stamps, whatever they're going to market to you, they're going to market to you. Now, some lenders will also own a servicing company. Mm-hmm. So, for example, our group, we own a servicing company. And so while our bank side, our mortgage side, rather, is responsible for handling all of the mortgage papers pre-closing, after closing, we may not want to do that the entire time. We may not want to send out every single thing. We may not want to be responsible for collecting your escrows for taxes and insurance and making sure those are paid, and reconciling when all of a sudden you closed on a house that was tax assessed at 200 grand. Now it's tax assessed at 400 grand, and your taxes double and your payment needs to change. So a lender has to be responsible for all of those things. And some of them are like, we don't have the staff for that. We don't want to do that. We're going to sell it to the servicer, and the servicer has enough staff for that back end work. And so the main answer, why do people sell? Money. The second answer, why do people sell? They don't have a lot of staff. They don't have the infrastructure to be able to handle all of the escrows and the phone calls, because people call all the time. Hey, I'm trying to make my mortgage payment. I can't do it online. And so they need to have staff to be able to handle those questions. Is
this everyone? The big banks do the same thing. That's the one thing I've run into a couple times with clients. They say, oh, well, I'm with, not trying to throw anybody under a bus, but they're, oh, I'm with Bank of America. And, I'm just very confident that they're going to be fine. And then all of a sudden, a couple months later, they go, they sold my loan. I said, yeah, everyone does it. And that's nothing against Bank of America. It is a common practice for everyone. So when you think you're going local and you're like, oh yeah, this small company, they're going to take care of me. They do it too. You think, oh, I'll go with the big one. The big boys know what they're doing. They've been in business forever. They do it too. So there's really no managing that up front, right? You just don't know.
You can't control if somebody. There are some that I advertise, we don't sell mortgages. We only keep it. It's just our stuff, which is fine. They're typically smaller local credit union type banks. I see a lot of that group in the country type settings. Like they're going to be a lot more branch oriented and very local oriented. They're also going to have super tight guidelines because they can't have defaults. So, because they are going to service that. If you default on a $200,000 loan, that's a huge hit to a smaller group than maybe to our group who does billions a month. 200,000 is not, no one wants that, but they're not going to even notice it. Where if you have $1 million credit line and you take $200,000 on a default, like that's a huge deal for small groups that are lending. So most everyone does it, not everyone, but most, I'd say 90% of the groups do. And you control 0% as a buyer to, I want you to sell it to this place. I don't want you to sell it to this place.
You don't get
the lender can't control that. That's the servicing that's coming out doing that.
Great stuff, Michael. One last thing, if you have an answer to this, that's great. If not, we can just finish up. But I always like to give people an opportunity to say, what's a crazy story, or your dad's story with Cabela's was pretty good, but is there something that just sticks out after your 15 years of your 15 years of dealing with this that you just go, I can't understand what they were thinking? Or somebody that just did something great that sticks out in your mind, like this was the model person of credit.
Yeah. So, probably some of the things that you're like, oh my gosh, like we've had people die the day of closing. Die. Like, why? Like we go to closing, they never showed up. Okay. And then, so they had to go back to their house, found out they had died before closing. So, so that's a little nuts.
Now, so that goes into, that doesn't go into, what's the term? Estate, right? Like then there's all kinds of things that fall
that was
into
our buyer who died. So the seller, we've had sellers die too, but the buyer died the night before closing. And so they can't come to closing. And so, but we didn't know this. We attended the closing. We just thought they were running late.
Mm-hmm.
They didn't do a walkthrough, and they had done it the night before.
There's no walking through. And
no more walkthroughs.
Yeah.
And so, so that's obviously very sad, but you're like, craziest stuff happens like that. Like you never know. And this is why people are like, hey, can we go ahead and move in early? Can we go? I'm like, you may want to move in, but I'm telling you, they can hit on the way to the car and like stuff happens. Like you just never know. And so, yeah, I would think the craziest thing I've ever happened is my buyer passing away the day before it closed, the day of the closing. And so
it's not funny, but we're laughing. I mean,
I
understand why it's something just like, wow, that's crazy. It's not we're laughing that someone passed, but the fact that timing is so crazy. Well, Michael Johnson.
I'll give you one other one, Scott.
Okay, yes, I want to hear it.
Okay, so this is from a realtor friend of mine. He goes to a showing to list the house. A wolf. They're in a condo. A wolf, not a dog, not a husky. A wolf comes around the corner. She has a pet wolf. Okay. So,
might want to have the wolf not be present for showing.
This is in Hamilton County, North Side.
Is that even legal?
I don't know, but this is like a $400,000 house. Okay, so this is and she wanted to keep the wolf in the house during showings.
No.
And I'm
really?
like,
well, I guess where are you going to take a wolf? It might just run away and go start murdering
walking,
things.
I guess. But I'm like, yeah, I don't know about that. So they had to. So this business is great.
Bless that agent to be able to manage that. Like, no, I really want to keep Wolfie here in the house during showings. Strangers won't be scared of a wolf. I mean, that'll really help my house sell, right?
Yeah.
No, ma'am. No.
We sold that to Red Riding Hood. She was fine.
Put your red cape on and take a walk with Wolfie. Get Wolfie out of here.
You'll be just fine. So.
Well, Michael Johnson, that's great stuff. Thank you. Very informational. Michael Johnson from Loan Depot. If you have any other questions about mortgages, hit us up. We really appreciate you being on the show. The information, the stories, it was all great. But hit us up with other questions, follow-up questions if you have any, because you never know, one of your questions might end up on a future podcast episode. So thank you for listening to the West Clay Realty Podcast. I'm Scott Pollard and Michael Johnson from Loan Depot. Thank you very much.
Thank you. Bye-bye.
Bye.
We hope you enjoyed the West Clay Realty Podcast. Be sure to like, subscribe, and ask questions. Who knows, your submission may be discussed in a future episode. Thanks for listening.